In this video, we're going to describe the corporate form of ownership and the journal entries for issuing common stock. Recall the three primary forms of business organizations. We had proprietorships, partnerships, and corporations. States issue corporate charters, and state laws largely govern corporations. And the accounting for stockholders' equity is going to follow the provisions of each state's Business Incorporation Act. And we'll see that play out when we discuss par value stock, no par stock, or stated value stock. In terms of characteristics of common stock, in the absence of any restrictive provisions, each share carries the following rights: to share proportionally in any profits and losses of the company, to share proportionally in management decisions, that is, typically each share of common stock is accompanied by a vote. That has really changed in recent years, particularly with tech companies, where some of the founders have reserved shares of stock with super voting rights. That is, say, voting rights of 1,000 votes per share compared to 1 vote per share for regular shareholders. That's where we have companies with multiple classes of common stock. Shareholders will share proportionately in any assets upon liquidation of the company. And then also we get what's referred to as a preemptive right. If the company issues new shares of the same class of common stock, we get the right of first refusal to buy a proportionate number of shares of those new shares that are issued. Common stock has a variety of ownership interests. It's referred to as a residual corporate interest. In other words, we get what's left over. Shareholders bear the ultimate risk of loss, but then also reap the benefits of success. We're not guaranteed dividends nor any assets upon dissolution of the company. And then there's also, we'll see, preferred stock. It's somewhat of a hybrid security that has characteristics of both common stock and debt. Like common stock, preferred shares get a dividend. Unlike common stock, preferred share dividends are often guaranteed and will have cumulative provisions. Unlike common stock, preferred stock doesn't get a share or a say in the management of the company. There's no vote. Preferred stock typically does have a face value, and that face value determines, along with the yield, the dividend that is regularly paid. But unlike debt, dividends to preferred shares don't have to be paid. Often there's cumulative features, but again, if we skip a preferred dividend, that doesn't lead to insolvency or bankruptcy claims. If we take an overview look at components of stockholders' equity, recall there are two primary sources of equity. That's the contributed capital and retained earnings. Retained earnings, again, are earnings that are reinvested or kept in the business. As a company generates earnings, profits, it can do one of two things: pay them out in dividends or keep them in the business, hence the word retained earnings. Our contributed capital, every company is going to have common stock. Some might also have preferred stock. And then the issue of par, no par, or stated value gives rise to what we refer to as additional paid-in capital. But all of these collectively can be thought of as contributed capital. Capital that investors have made in the business or contributed to the business. We're going to take a look at three issues related to selling or issuing common stock, and those relate to whether the stock is par value stock, no par, and then also the cost related to issuing stock. How do we account for them? In later videos, we'll look at how we account for stock issued in non-cash transactions, and then also stock issued in combination with other securities, say stock and bonds issued together or common stock and preferred stock issued together. Now, when we issue common stocks, corporations maintain accounts for preferred stock or common stock at their par value, and then also an additional account referred to as paid-in capital of excess of par or additional paid-in capital. I'm going to shortcut the name on our Excel worksheets to just paid-in capital and then reference common stock or preferred stock just to keep the account name shorter. And we'll see that par value is essentially an arbitrary amount that has nothing to do with the stock's fair value or price. For instance, Tesla's common stock has a par value equal to 1/10 of 1 cent per share. And we could ask, what's Tesla worth? Well, before the recent 4-for-1 stock split, Tesla traded for as much as $2,150, with analysts offering forecasts for a range of Tesla's value for the next 12 months as high as $2,500 and as low as $87 a share. So who knows what Tesla's worth? If we look at a graph of share prices, and this has been adjusted for the 4-for-1 stock split, we can see that it's been on a tear in recent years. Over the last 12-month period, it's nearly quintupled, and now it's worth more than all of the major car companies combined. But one could really ask, is it worth that? And in terms of stock splits, we'll talk about stock splits a bit more later on. But for now, let's get back to the basics. Par value of stock. States' laws vary with respect to par value. Low par values help companies avoid a contingent liability. And again, par value really comes into play only when companies are in financial distress. We typically can't pay out dividends in excess of the capital that has been contributed by shareholders as it has been defined by states. And typically states that have par value stock, you can't pay out dividends or make distributions to shareholders that would reduce that common stock account below its initial contributed amount. So it would make sense to keep that par value of common stock account as low as possible. Hence Tesla having a par value of 1/10 of 1 cent per share. It gives it greater flexibility in making distributions to shareholders. And again, that really only comes into play when companies are in financial distress. Let's take a look at journal entries for recording par value stock. We'll assume the Blue Diamond Corporation issues 300 shares of $10 par value stock for $4,500. What's the journal entry? Well, of course, we're going to debit cash for $4,500. And rather than crediting common stock for $4,500, we break it into two accounts. The common stock, which is the amount that we record 300 shares at that $10 par value. And then the difference is simply credited to paid-in capital in excess of par. We mentioned earlier that companies can issue no par stocks. And again, the primary reason is it avoids that contingent liability associated with par value. And it avoids confusion over recording par values versus fair values when the shares are issued. The book does point out some disadvantages, and one of the main disadvantages is that some states levy a high tax on these types of issues. And then also, in some states, the total fair value can be considered legal capital, which again would further reduce flexibility in paying dividends and sort of cancel out that primary advantage of no par stock. Let's take a look at a simple transaction. Video Electronics is organized and authorized common stock of 10,000 shares without a par value, so no par stock. If it issues 500 shares at $10 per share, what journal entry does it make? Well, it just $5,000 in cash. And we'll debit cash for $5,000 and credit common stock for $5,000. Then finally, we had mentioned the concept of stated value stock. Stated value stock, again, legal differences from state to state, but from an accounting perspective, it's really no difference than a par value stock. So we've got a company issuing 1,000 shares with a $5 stated value at $15 per share for cash. It's going to make the following entry. Debit cash for $15,000, credit common stock for the $5,000, that's the 1,000 shares at the $5 per share stated value rather than par value. And then notice the paid-in capital is referenced as in excess of stated value rather than par value. But otherwise, it's the same. Let's go ahead and take a look at some examples. In the first year of operations, Colin Ray Corporation had the following transactions related to the issuance of common stock. It issued shares on January 10th, 80,000 shares. On March 1st, it exchanged or issued 5,000 shares in payment to an attorney for services helping incorporate the company. And on July 1st, it issued an additional 30,000 shares. Let's go ahead and take a look at the journal entries. On January 10, we issued 80,000 shares at $6 per share. So we're going to debit cash for $480,000, number of shares times the price. Again, this is par value stock, and we're told that the stock has a par value of $5 per share. So we're going to credit common stock for $400,000. That's the 80,000 shares times $5 a share. And the difference gets recorded in paid-in capital of excess of par for common stock. Transaction on March 1st, we're told that we have paid an attorney for help in organizing our company in the amount of $35,000. And instead of giving them cash, we gave them 5,000 shares of stock. So we will debit an expense, and we will debit organizational expense for $35,000. And of course, we've issued 5,000 shares of $5 par value common stock. So we need to credit common stock for $25,000, and the difference will get credited to additional paid-in capital of excess of par, $10,000. July 1st, we issue another 30,000 shares for $8 per share. 30,000 times 8 is $240,000 in cash. 30,000 times the $5 par value means $150,000 for common stock. And of course, the difference goes to additional paid-in capital. Now, how would our journal entry change if when we issued the stocks, the underwriter charged us $7,000 in underwriting cost? What would change with respect to our journal entry? Instead of getting $480,000 in cash, we will only get $473,000 in cash. That's the $480 minus the $7,000 in underwriting fees. We will still record common stock at its par value of $400,000. And of course, the difference between the two, once again, will get charged to additional paid-in capital, or capital in excess of par. Now let's take a look at the same transactions, assuming the common stock is no par with a stated value of $3 per share. Well, on January 10, we get the same $480,000. That's the 80,000 shares times $6 per share. But now instead of recording common stock at par, we record common stock at its stated value of 80,000 times 3. $80,000 shares times 3, and of course we have additional paid-in capital of excess of the stated value rather than par value, and that's the $240. For the attorney's fees, once again we have organizational expenses of $35,000. The common stock is recorded at its stated value, 5,000 shares times 3. And the difference between the $35,000 and the $15,000, $20,000 gets recorded to paid-in capital of excess of stated value. For the 30,000 shares issued on July 1st, again, we receive $240,000. We record the common stock at the stated value of $3 per share. 30 times 3 is 90,000. And again, the difference goes to paid-in capital of excess of our stated value.